Hi, it's Roman from PensionCraft. The US volatility market has just crashed. If you don't know what volatility is, you really should. It's a very important risk measure for any investor. Want to find out? Watch this video. A standard fear gauge in the US is called the VIX index. No, it's not the cold remedy. It's a measure of volatility for US stocks. This is the picture over the last 30 years. At the top is the VIX index. At the bottom is the S&P 500 stock index. The shaded grey blocks are recessions in the United States, and usually recessions come with an earnings crash for US equity, and with recession comes very sharp falls in the equity market. In 2008, VIX spiked up to 60%. So wait, what is volatility? This is the price of an imaginary stock which starts off on day 0 at a value of £100. On day 1, the stock rises by 1%. The typical daily return then is 1% so far. On day 2, the price rises to £103, so it's gone up another 2%. The typical daily return is now 0.7%. On day 3, the price doesn't move. We can start to build a picture of the typical daily move of the stock. After 5 days, this comes out at 2.2%. In practice, we use much longer periods than 5 days. On the left is the daily share price for a large UK stock for the last 25 years. In the middle are those daily returns that we calculated before. Most of the time it's around 0. On the right, we've split the returns into buckets. So for every day over the last 30 years, we work out the return and then throw it into one of the return buckets. And you can see that 0% is the most likely bucket. So the most likely thing is that the stock doesn't move at all. And most of the time, it just moves a little bit up and down. On some freaky days, it moves up 10% or down 10%. But that's very unusual. So what's the typical daily return? Well, for this stock, which was Glaxo, the typical daily move was 1.3%. If we scale that up to an annual move, that's 21% per year. If you don't want to lose 21% of your capital in a typical year, do not buy equity. Buy something like a bond where the volatility and the risk is much lower. So what does the volatility crash in the US mean? Whenever there's a crisis, such as a war in the Middle East, a financial shock, an emerging market crisis, or a bubble bursting in the stock market, you get a volatility spike and the market crashes. And I've labelled those spikes on this chart. The average level of VIX from 1990 to just before the financial crisis was about 19%. You can see there are long periods when VIX switches between low levels and high levels. In the early 90s, vol stayed low for about 5 years, below 15%. Then it spent 5 years at about 25% with various spikes, then another low period of about 15% for 5 years. So are we entering a new volatility regime when vol is really low? Probably not. Here we zoom into the last year with the US S&P index at the top and VIX at the bottom. And you can see what's got people talking. VIX is almost at 10%. That's very low. But you can also see that's because of the Trump rally. The S&P's up about 10% since he was elected. And the primary reason for that is his tax policy. If he cuts corporate tax from 35% to 15%, then that instantly boosts earnings for companies and pushes up their stock price. The stuff in red on our 2017 investment map are volatility triggers. All of these could cause a sell-off in equity markets and a spike in volatility. It could be Trump's protectionist policies, which could trigger a China hard landing. It could be an emerging market debt crisis triggered by the stronger dollar, or it could be a Eurosceptic landslide in the European elections this year. So we don't think this is a low vol regime. If you want more than 2 minutes on volatility, such as how to buy it and how to sell it, and trading strategies for vol, then why not buy my book on Amazon? That's it from us. Have a great day.